Hall, James Canane Jr.,
Here.
Brian Hanson,
Here.
Emily Koenig,
Here.
Lieutenant Colonel Gerald Lohr,
Here.
Jody Patterson,
Here.
Anthony Waskowitz,
Here.
Milton Wilkins.
Here.
Thank you.
Great, thank you, Matt. Let's move to the first agenda item after the roll call, which is the approval of minutes. Everyone's had a chance to review the minutes, hopefully. If there's any comments, please get them out there. Otherwise, I'll ask for a motion to approve.
Motion.
Motion for Brian,
Second.
second for Jerry. All in favor?
Aye.
Aye.
Opposed? Great, minutes are. Was there a comment? We'll move on to the request for benefits. Oh, we need to meeting minutes for the closed session need to be approved as well.
Motion, we have to make a motion to approve. Yeah. I'll make that motion. Second.
Second. All in favor?
Aye.
Opposed? Okay. Thank you. So those sets of minutes are approved. Thank you very much. We'll move on to the request for benefits. Becky, anything interesting this month?
No, I think everybody for your patience in sending me the last minute ones on the death benefits, as I mentioned, when we do have somebody come in at the last minute, I'm not putting, just for items two, I'm not putting the number of deaths on the agenda. One, it says we don't have to, but the reason I do that is so yesterday, Debbie got a last minute, all the information in the death certificate and everything so that I could add somebody, last minute, but that way we could get the transfer going instead of waiting another month. So that's why death benefit for Dorothy was added. So outside of that, no interesting or unusual things this month.
Okay, thank you. And are there any questions or inquiries anyone has before we start our way through these? Okay, then let's work our way through these four. The first is the civilian retirement benefits. If we can have a motion on the civilian retirement benefits. Brian has a motion. Need a second.
Second.
Jerry, thank you for the second. All in favor?
Aye.
Aye.
Opposed? Okay, thank you. We'll move on to the police retirement benefits. And, we can get a motion there.
I'll make a motion.
Jerry has a motion.
I'll
We'll need a second. Brian has a second. All in favor?
Aye.
Aye.
Okay, we're approved on retirement benefits. We'll move to the civilian death benefits. We can get a motion there. Brian, motion.
Second.
Jerry, second. All in favor?
Aye.
Opposed? Okay, we're carried there. And then police death benefit, was that really extra, were the new personnel?
The new personnel.
So it's not on the.
No.
Okay, just confirm. Thank you.
Maggie, do we need to move it all on that or sign board orders for none? PD?
No.
Okay, thank you. I'll do that.
Okay. All right, great. Thank you very much. So we're going to move on to ACG's portion of the presentation. We've changed, we're moving a little bit off the agenda today due to some time constraints of a couple of the board members and also just feeling like next month might be better for one or two of the items. So with that, Finney, jump in and take it from here.
All right. Yeah, so today we have an update really on the marketplace and our performance. So there's a couple things in front of you. And I'll start with, we're going to go back. So start with the big book. Everybody has, and we're going to go back. So Becky's the quarterly report.
Yes, sir.
If you want to share that on the screen. We'll go back. This is as of June 30th. And so maybe if everyone could flip to page 20, which is actually in tab 2 in this book. So again, as always, so this goes back to June 30th, and markets really have rebounded as we've seen and we know this year. So again, 2022 started the year out, interest rates were very, very low, inflation was very high. The Fed did a lot of work to raise interest rates to then bring that inflation back numbers down. And what we've seen really throughout this year, we've talked quite a bit about it, is really they've had some success in bringing these inflation figures down. It's given a lot of positive momentum to the economy. And so we'll look at actual index returns, market returns here in a minute, but overall, just, you know, always like to start with dollars. So here on page 20, if you look at that second column year to date, so at the beginning here of 23, we started out at $777 million in the portfolio. In the first 6 months of the calendar year, we've taken out about 13 as it relates to benefit payments. And then the portfolio has made up $63 million really from this positive momentum. And that's both from fixed income side as well as the equity side. So we ended this the first half of the calendar year just under $830 million in the portfolio at 828. And again, you can look back over longer term to see just kind of how and where we got there, particularly 3 years ago. So again, that was in the summer of 20, still kind of in the height of COVID. We had about $725 million in the portfolio. You can see over the last 36 months, we've added, you know, almost $178 million to the bottom line. And I always think it's nice to point out, you know, you look longer term back here. So if you look at 10 years, so that's June 30th, 2013, we're at just over $500 million in our portfolio. And our number one job, of course, is to be there to pay the benefit payments. You can see we've taken out about $200 million over this last decade. But the portfolio basically doubled in terms of investment size over the last decade, up another $500 million. So again, really doing a great job over the long term, what it's supposed to do. From an allocation perspective, just on the next page of 21, you can see here's us, our actual allocations as of June 30 relative to our targets. Obviously, do a lot of work setting our strategic policy target. And that fourth column, I'll just point to it, the over and underweight from an equity, fixed income, real asset perspective. We're very close to our targets, pretty much in line. Again, kind of the big thing continues to be, as everyone knows, I don't want to talk about real estate here in a minute, but last year in 2022, real estate really that diversifier, the protector for our portfolio when both stocks and bonds went down. So like most people, we put in a redemption request to rebalance. Our managers, REEF in particular, has put up, you know, it's a little line to get out. So we actually put in a request in for $20 million. Just as a reminder, last year, we've gotten 7 of that back. So we still have 13 to go. So that's about 1.5% to 2%. So you can see that overweight to real assets. That's really where it's coming from. And so we still expect to get some real estate dollars back. So in line certainly with our allocations. And then flip to page 27 and we'll look at our performance. So, and as I mentioned, as we know, this year 23, we talked a lot about it this year. Markets certainly have rebounded to the positive side. You know, strong expectations coming off a lot of that uncertainty last year. Our portfolio, as we know, is very much set up to be, you know, Jason and I talked a lot about kind of sometimes a high beta portfolio. Certainly as markets go up, we expect to perform quite well. And that is very much what we've seen this year. So, and again, what we have here, this is our portfolio, and these returns are all net of all manager fees. What we're showing here at the total portfolio level, this blue line, is our returns. And then again, just a reminder of what we're comparing ourselves to here. First and foremost, that second line, the strategic policy index, this is if really we were to invest passively across equities, fixed income, and real estate, although you can't really invest passively in real estate. But it's 63% equities, 22% bonds, 15% real estate. What the line above it, the broad policy index is that basically takes real estate out. So it's just stocks and bonds. So that 15% real estate goes to equities. So it's 78 equities, 22 bonds. And I point this out because look at that difference between the strategic policy and the broad policy index. Last year, as I mentioned, 2022, real estate really didn't provide a lot of protection for our portfolio. That pendulum has swung this year. Particularly as rates has gone up, we've seen real estate prices come down, whereas at the same time, equities and bonds from the appreciation have certainly gone up. And so again, just kind of point of why we diversify our portfolio. Real estate was great last year, but from kind of return standpoint, it's brought us down a little bit this year. And then finally, this fourth column, this public DB, $100 to $1 billion, we compare ourselves to a universe, and it's about 165 other public pension plans in the U.S. that have between $100 million and $1 billion in their portfolio. So again, we certainly fit within that realm. What we're showing here is the median performance, but of course, up here next to our returns is how we rank relative to that overall universe. And again, with the ranks, 1 is the best, 100 is the worst, is the best way to think about it. So again, just quickly looking across, The second quarter of the calendar year, we were up almost 3.5%, 3.4, certainly quite strong. We're in the first half of our peer universe, outperforming both our strategic policy index. But you can see real estate hurt us versus the broad policy index. Not surprising for the first quarter. Year to date, I showed that almost 63 or something $million we made so far this year. That's from a return standpoint, over 8% return we've had in the first 6 months of the calendar year. You can see pretty strong outperformance both towards our strategic policy. You can see we're just outside the top third of other public pension plans. So again, when markets go up, we tend to certainly appreciate and do quite well. Looking out longer term, you can see the returns. Certainly, again, I think thinking back to what our trailing returns were at the beginning of the year after 2022, these numbers are moving up quite a bit. You can see over the last year, we're up 8.6%, so since June 30 of last year. And over the last 3 years, so again, this includes the up this year, the down last year, kind of a lot of those, market cycles, we're up almost 7.6%. You can see kind of a little bit below the broad policy index, but ahead of our strategic policy index and in the top half versus other public pension plans. So again, kind of overall, this full cycle, continue to think we'll perform quite well. Longer term returns continue to be strong. You can see over the 10 years, again, up over 7.6% per year, certainly quite strong. And you can see ahead of both our policy indexes, as well as, ahead of the top half of the public plan universe. And I do want to make the point, just looking down, particularly over the last year, as we look at our individual managers. So for the 1 year, you can see we're up 8.6%. Pretty strong return for a 1 year period. You can see we are just slightly in the bottom half versus our peers on the public plan, which for 1 year itself it's fine. It's not that bad. But really, it's not so much the managers. As you look down the manager column and onto the next page, our managers over the last year really performed quite well. It's actually over the last 12 months, it's been real estate. We have, again, about a 15% allocation of real estate. Relative to other public pension plans, the average is somewhere between 7 to 10%. So we're a little bit overweight real estate, which again helped us a lot last year, but relative to peers over the last 12 months did bring us down a little bit. But just quickly kind of looking down, and I'll hit some highlights on the individual managers here. So within large cap, so you can see certainly year to date, and particularly over the last year, really strong performance from all 3 of our managers. Aristotle on the value side, showing some strong performance in the top half versus its peer group. And then Jennison, I want to point out, and I'll get to this in a minute here, but we've talked about Jennison a lot. Jennison is our large cap growth manager. They really have a lot of exposure to what they call really high growth. We think about that as really technology, a lot of these kind of Microsoft, AI type platforms. This really ran up earlier this year. It ran up certainly in 2020. So Jennison definitely benefits from those periods. But in a year like 22, when it falls off, they can be a laggard. But you can see, well, last year was a tougher year for Jennison. You can see so far this year really adding quite a bit of value. Strong performance continues in our small cap market. You can see Earnest, not only in the top third of its peer group, but over 5% ahead of its benchmark over the last 12 months. Granted, a little bit struggling relative to the core benchmark. You can see over the last 12 months, still up over 11%, and longer term, since we've had, over the last 5 years, you can see, 2.5% on a per year basis ahead of the Russell 2000. So really no concerns within Granite. With international, and I want to make a point out here, you can see kind of it stands across the page. Sanderson, over the last, certainly year to date, is in that second percentile relative to other large cap managers within international. And over the last year is in that third percentile. So really strong rebound from how the portfolio is allocated. Again, when we talked about replacing Sanderson, with us, it was never necessarily their philosophy or their process. It was more so the assets they had under management. And we were a little bit worried about kind of what would happen there. Well, one update we just received is Sanderson is actually shutting its fund down as of the end of August. So again, kind of, I think if nothing else, this is a great example of why us or the board, we have these conversations. Again, we thought Sanderson itself on the investment side was doing okay on the rebound, but if we didn't already have a backup in place, which we do with Silchester and done that work, we'd be in a tough spot right now. So again, it's also very important to remember the qualitative issues we're looking at these managers for.
Excuse me.
Mel, are you asking the question?
Yes.
Yeah, one question. When would you anticipate we would receive the total proceeds from Sanderson?
Perfect. Yes. No, so I think it's September 8th. So the plan, if everyone can remember, we talked about the transition going through is actually, we are in process right now of making our withdrawal request, I should say, from Western of $50 million.
Right?
And so remember, we're using Western as the temporary funding source. So
Yeah,
that-
bridge financing.
I think sometime this week. And Milt, we were able to then invest with Silchester. All the docs are lined up or set up for September 1st funding. And
Good.
then all the Anderson proceeds will come back, like I said, a week later, and we'll be able to then put that back into Western. Does everyone remember that process? Happy to answer any questions, but it's going along kind of exactly as we had laid out.
Very good.
So again, just a good reminder of why we look at the qualitative issues. WCM, again, a little bit more growth oriented, but so certainly that's helped them with their outperformance. We can see that here, certainly over the last year. And again, it'll continue to be a good pairing with Silchester. Within our international small cap managers, Mondrian on this page and William Blair on the other side. Just a little bit of preview as we get this Silchester funding ongoing. The next thing I think we really want to look at is this small cap international portfolio. So we have two managers that in aggregate come up with, it's a little bit less than 5% of our overall portfolio. Mondrian's one in themselves are certainly quite defensive and more value oriented, but have continued to struggle from a performance standpoint. We had members of our team in their office in London earlier this summer. They've recently been here and been in our office. I think they recently met with Milt. So again, we want to dive into this further. We've been unhappy with their performance. But again, I think even if between Mondrian and William Blair together is a little bit less than 5% of our portfolio, we want to look at maybe there's potential other options or making a combination. In particular, if everyone can remember, Silchester is a little bit more all cap, so they have more small cap in their portfolio. So we might actually need less in our dedicated international small cap. So again, I'm just pointing this out that we're certainly watching this, looking at it, and we're going to come back soon with some more thoughts.
Yeah, by the way, when you do come back, Phineas and Jason, I'd like an understanding whether or not Silchester specifically targets a certain percentage of small cap stocks, or is it simply osmosis?
Yeah, and we'll flush it out.
And could that allocation, in fact, it may be X today and X plus plus tomorrow?
Yeah. So we'll,
Because we do want to have a dedicated exposure to small cap stocks and should not be left to the, my opinion, it shouldn't be left to happenstance as to whether Silchester is consistent with that focus or decides to reallocate most of the money in the mid and large cap stocks. That's all.
no, and we'll flesh that out. Just kind of, quick thoughts on it. It is more osmosis with Silchester. They start with that cheapest quintile, as they call it, the 20% in the universe, and their universe is pretty large. So kind of just by happenstance, a lot of times, a lot of those smaller names fall in there, but it does vary, Bill. So we'll certainly bring that back and want to highlight that because that's a very important point. There's not always a dedicated allocation.
Okay, thank you.
No problem. And then just quickly, Acadian, again, continues to perform very well within emerging markets. As a reminder, we used to have two managers in emerging markets, LSV and Acadian. We combined that to one and continue to see a lot of fruit from those efforts. Within fixed income, really, IRNM and Western kind of doing their jobs, particularly IRNM, providing some protection there. Now, again, IRNM more of our core manager, Western our core plus. So what we mean by that, takes a little bit on the higher yield, more speculative securities than the fixed income portfolio. So last year, 2022 in particular, really hurt them. Certainly as interest rates moved up, we saw really overall equity markets fall back. Western has been able to redeploy a lot of their portfolio in these higher yielding securities. So we've already even seen to start this year kind of a strong rebound with them. But we have no really concerns there. And then within real estate, again, I mentioned just to look at the numbers, our managers really kind of, Reef, Heitman, and Chris is on the next page, holding it pretty well over the last 12 months. Certainly doing better than the Odyssey, but again, the Odyssey, it's a combination, several different real estate managers, down over 10% over the last 12 months. Again, so as we talked about, real estate's certainly been struggling, but over the last 3 years in aggregate, our managers, even though they're down about 9% the last 12 months, up an annualized 8 to 9%. So again, certainly we experienced those strong returns last year. Very happy with the team at real estate. Any questions? I'm not transitioning from performance, but I do have just updated July 31st numbers that I can bring to you quickly. And just on the market front, actually, if you guys can flip to the first page here of that, so it's the piece that says market update and portfolio review. So, and I just want to make this point again, I mentioned markets continue to be strong this year, and really particularly, Jennison's benefited. Really, this technology sector has really improved. So what's happened this year? Again, think back to January, everyone's talking about recession. When, if, are we heading into recession this year? And all we've seen is the economy continue to really accelerate. We had strong GDP numbers in both the first and second quarter. Second quarters came out here in July. The Fed actually took a pause this summer for the first time in raising rates. For the first time in a long time. They did raise it again in July. They just met again last week to say they continue to certainly want to fight inflation. That is their priority. But markets expecting maybe one more hike this year. So certainly a lot different than last year. Because overall, we are seeing CPI, the inflation number headline is right about 3%. So a little bit higher than the Fed's 2% target, much lower than the 7, 8, 9% last year. But again, looking back here on the left-hand side of this page of returns from the major indices, the dark blue is July. And you can see really strong bounces, first in international, but also even EFA and the S&P 500. Really strong returns. And of course, year to date, this lighter blue number. So 7 months of the year, very strong returns from the equity market. But what I want to point out, again, is just how concentrated some of this leadership has been. So if you look at that S&P 500 line, it's up about 20%, 20.5% through the first 7 months of the year. Go down to the bottom right graph. The way you can see, we're breaking out the contribution here of these 7 different stocks. If you've heard the Magnificent Seven, it's not an Avengers movie, it's these kind of 7 stocks that the market keeps talking about. Google, Tesla, Meta, Amazon, NVIDIA, chipmaker, Apple, Microsoft. And it is a little bit of a tale, somewhat 2 different stories. So the first 5 months of the year, the S&P was up about 10%. But pretty much those 7 made up that entire 10%. And actually, the other 493 were slightly negative. Now, June and July, those gray bars certainly added much more contribution. But still, those 7 had a pretty decent impact on it. So again, it's continued to be this concentrated leadership. So again, managers like Jennison, and also our passive exposure certainly have exposure there. But that's also, we have like an Aristotle who does look at other different managers.
What is the overall weight of those 7 stocks in the ballpark?
15 to 20. I think it's around 20%. Actually, I think the top 10 is closer to 20, 25. I don't know what the 7 in particular are. You know what it is, Brian?
I thought the 7 were like over 25.
The 7 are over 25 now. Maybe after this, yeah. So it's just about.
Just becomes an interesting thing as you think about passive versus active strategies, and you start getting extreme concentration, and even your passive strategies start making an awfully big bet on those handful of securities.
Right. And then the question is too, as you look from a manager evaluation standpoint, how even owning those 7, if they are 25% of the index, even if your portfolio they only make up 15% of the index, that's a big relative bet. Right. That you kind of spreading those out. And so it's, how different do you want to be from, I guess, the market? So it's certainly interesting.
Thank you.
No problem. And maybe just kind of flip in here to our actual returns. So at the end of,
could you look at our large cap portfolio in the aggregate when you take in the value manager and the growth manager and compare the weightings of those 7 to just straight passive? I'm just wondering, I would hope that the result would be that it would bring those weightings down at the margin. But I can imagine Jennison having a number of these names, and frankly, Aristotle probably has a handful or 2 or 3 of them in their portfolio too, because they had a little bit of when we met with them, they had a little bit of a tech allocation.
They do, and I think, and certainly Jennison, what you'll see for some of these in particular, maybe not all 7, but most of them, like Tesla, certainly, they'll have a larger weight than the benchmark will. And then, so we add in Aristotle, they'll have exposure to some of these, and that'll ultimately bring that down. So off the top of my head, I think we're probably relatively in aggregate, close to market weight, but I'll bring that back. Sure.
And that's what I'm wondering. And then the question would be based on what you find. Would it be ACG's recommendation to do anything to mitigate that exposure to that concentration risk?
Yeah, and I think what would be helpful too is, so if we know that 7 stocks make up, let's say, overall a quarter of our large cap exposure, what are the pros and cons of that, right? We don't have a crystal ball.
Right.
But I mean, what you're signing up for is you work to say diversification, but at the same time, you're gonna look a lot different than
And the benchmark
benchmark and
returns. That's right.
peers and the overall marketplace.
Right.
So yeah, we can definitely expand on that further.
Yeah, thanks for that follow, Brian, because that was the second question to what I asked. I'm
Right.
kind of just trying to tease out with all this extreme concentration, what do we look like?
Right.
I think we need to be cognizant of the amount of risk we're putting into a
Right.
handful of securities.
We're likely to get the benchmark return. The question is, are we comfortable with that level of concentration?
Yep.
Excuse me, if I can add something, I just referred to Morningstar. And if you take the top 7 companies in the S&P 500, according to Morningstar, they represent 26% of the weight of the S&P 500.
Yeah, somewhere on
Or if you take the top 9 companies, that would also include Berkshire Hathaway and United Health. And they have, neither of which obviously are particularly tech oriented. But 7 of those companies, 7 of the top 9 companies represent 26%. Has been higher. Okay.
Thank you, Bill.
So then just quickly on returns, July again was positive, so we were up another 2.25%. So bringing our year-to-date number, it's almost 10.5. 10.4% again, these are net of fees, ahead of our strategic benchmark, but again, below our broad policy index given the real estate exposure. And then just maybe quickly, because it's not on the quarterly reports. So again, I talked a lot about the managers, but maybe just again want to point out, and I know we talk about the kind of active passive quite a bit, but starting on page 6, and you can go to the next page with our managers. So the since inception all the way to the right. So again, these returns are net of fees, and we have 15 different managers in our portfolio. 11 of the 15, since we put them in place, are outpacing their respective benchmarks net of fees. The ones that aren't, quickly are just at the very top, Aristotle, which is below by 3 basis points, over the last 2 years. So we think, certainly it's been a tough environment, but there's some ebbs and flows there. Rumline, which is passive, so kind of by definition, they are going to trail their benchmark. They're trying to meet it and save fees. And then again, looking at our 2 international small cap managers here at the bottom, Mondrian and William Blair, who both have a core benchmark and also a secondary benchmark, and you can look at both of them. William Blair a little bit closer, but over kind of long periods of time. You can see both under 0.5%. So again, this area we do want to kind of re-explore and reevaluate our small cap international portfolio and how we're situated. But really kind of overall, long term, there are certainly different cycles, and we know when you sign up to be an active manager, you're going to be different than the benchmark, and sometimes that'll go against you. But ultimately, from a manager standpoint, continue to be happy with their long-term performance.
You'll probably cover this next month, but I'll just plant it now. I'm just curious on the MSCI World ex-US small cap benchmark. Is there a ETF that replicates it? And what has their track record been of being able to replicate it?
Being able to replicate it?
Right, because I know as you get more esoteric in terms of benchmarks and asset classes, it's actually hard you can't always get exposure. I know that's the case on fixed income, high yield. We run some passive portfolios, asset allocation portfolios, and going back to 2008, 2009, the argument was to move into preferreds and high yield to get equity-like exposure with lower volatility. But the passive funds were unable to replicate the benchmarks and had 400 to 500 basis point deviations. So you got the call right, but the implementation vehicle wasn't able to match right. And so I would assume that is a higher risk with something as esoteric as international small cap.
Yeah,
But I don't know that for sure. So
we will quantify that, but directionally, you're 100% right, that it is harder, the tracking error goes up. You're not, it's not like large cap drumline where you're able to get that exposure. You're not. And also, now as the tracking error go up, the fees go up. So it's not 4 or 5 basis points like
Or
it was
pass
for a run line. I mean, you're looking closer to sometimes 1/3% to closer to 0.5%.
Yep.
Yeah. Right,
Okay, thanks.
But that's kind of what we had today was really just kind of an update on markets and our performance. We went through a lot kind of on the managers and our portfolio, but any questions?
Okay, without questions, thanks, Benny, and you've created quite a list for yourself for next month. That's right. We've got active, passive, concentration of the big seven, investment policy statement, and a look at the international developed portfolio. So we'll have a lot on your plate for next month.
It's good. Luckily, it's all kind of related, so I think it's
Yeah,
pretty well.
it all plays together. Agreed. And so I think we covered the Sanderson and Silchester update. So, and when we draft the investment policy, so I think we can move to the COLA review. So Paul, you did some great work on that, and can I have you kick off a conversation on COLA review? Thanks.
Thank you, sir.
And can I, before we jump in, there's another agenda item, 11, on correspondence from Joyce that was specific to this COLA review. There were a couple questions in there. I do believe that the conversation Paul's going to have and some of the Q&A should cover those items. To the degree they don't, of course, you'll have your 3 minutes, or we can.
Well, I was with the understanding that I wouldn't need to present because I can't ask questions.
That's
What I
great.
had was questions, so
Yeah,
if she's going to answer them, I'm fine with that.
and I think we've got the questions that were good questions. I hope we'll address them in the conversation, and then you'll have 3 minutes afterwards as well when we get to the visitor comments.
Thank you.
Okay. Thank you, Paul.
Thank you, Jim. So every year, once we finish the valuation, we then move to considering the COLA. We talked about the valuation last month. So this month is the COLA discussion. So you have a 3-page letter in front of you. The first page and a half is really just doing background. It's talking about why we do this, how we're allowed to do this. It talks about what's been done in the last 2 years. So you can see the brief history in the table on the first page, just what's been done over the last couple years. Down at the bottom, we added a section talking about what has been the guidelines that the board has used in the recently to decide whether they want to move forward with a COLA or not. Going to page 2, we also added some history on recent inflation experience, just so you can see that, yes, over 1 year, maybe it's been high, about 6.5% based on December. Yes, there is a typo on page 2, but on December, over a 1-year period, it's been about 6.5%. Over longer periods of time, it gets lower and lower because we know we've got those lower inflations that we're building into the history. So short term, it has been higher. You move to July, even though we note there that the first 7 months was about 3%. If you did July over July, it was about 3.2%. So there is a big blip that we're all aware of, but that sort of is phasing into the longer periods of time now. When it comes to what we actually considered, Jim and I discussed this and came up with 3 scenarios, which are shown on the middle of page 2. The first 2 are very similar. I really just wanted to show what would happen if we gave a level amount to everyone. So scenario 1's looking at providing 1% to all current retirees as of 1/1/2023. Then just to prove to you mathematically that it would work if you went to 2.5% or something, I provided scenario 2, which gives 3%. So the math will show that it's very transparent. If you all decide to go at 1.5%, you can easily see what the impact would be there. The other alternative here, so scenario 1's sort of saying everybody's been treated consistently in the past, perhaps you could say. And so we're going to give something to everybody. Scenario 3 saying maybe there is a shortfall or we want to give focused amounts to certain groups. And so that would be, let me read it so I don't mess this up. 5% to those who commenced benefits during calendar 2020, I'm just going to keep saying 2012. Another 5% for those who commenced in calendar 2017. So those 5-year and 10-year increments, they would be getting 5%. And then for people who have retired in the last few years, so 2018 to 2020, some of the newer retirees would get 2%. Okay, if you're not mentioned here, you're not getting anything. So people prior to 2012, for instance, are not getting an additional COLA as part of this scenario. Okay, so we got a table of it then, so you can sort of see how things line up with the past years that we showed on page 1 and what we're trying to do now. We keep adding years, so it's going to get cumbersome at some point, but I think it works to sort of show what we're trying to target. When you go to page 3, then you can see the direct numbers. And so we're showing here on for each scenario, and then the baseline, which is the valuation results. We're showing the funded ratio under 2 measures. One is sort of what we normally consider for funding purposes, which is using that smooth value of assets, not trying to blend gains and losses from investment experience over a period of time so that we don't have large spikes in our contribution. That's that top line. The second line is looking at just what are my assets versus what is in the trust, the market value. And so that's quite a bit lower in the valuation. The smooth value was about 75.3%. The market value was about 10% lower than that at 65%. So we show those 2 funded ratios for each scenario. We also show then on the last line the impact on the annual contribution, the expected contribution, if these had been in place at 1/1/23 when we did this costing. So each scenario is going to take the contribution up a little bit. It's just a matter of how much. Okay, so let me pause there and see what questions you all might have.
So I have some comments. So just looking at a couple of the questions that have come in and then the memo that you provided. So one of the questions that was raised was the idea of, do we consider inflation as a group? And I think, as I think about it, at least the ordinance that we're looking at says to look at inflation and look at the solvency of the plan. So I think the answer is yes, we need to look at inflation. And I think that the inflation numbers that you provided here show high short-term inflation and long-term inflation, that's about 2.5%, give or take. And so if you look at the question then of the scenarios, I think the scenarios generated, Paul, you mentioned that it was a conversation between you and me. It's a little broader than that, in my view. There was some input from staff here. There were input from some other board members. But the general concept was, as you described, that we looked at what about a 1 or 3% increase across the board. You look at that 10-year inflation rate of 2.6%, 3 is a little higher, 1's lower. So longer term, that would be consistent with long-term inflation if we were to go down that type of an approach. Scenario 3 is kind of continuing along the path we have for the last 2 years, which is trying to continue to adjust certain years. And I think the board could have an interesting discussion as to whether one, are we going forward with a COLA, and 2, do we want to continue along this past path, or do we want to say, okay, we've caught everyone up. Now let's start to simplify and just move forward with consistent increases across the board. I think it's a good question as we move forward. And then lastly, and this is a question that I share, but a question that came in, does the difference in the funding ratios between the police and the civilians matter from a standpoint of consideration? I guess from my view, I've always looked at just the entire funding ratio as the question for this board to consider when considering a COLA, but I'm curious as to your or Maggie or anyone else's views as to whether that's our correct view.
Well, I think the plan has one fund. And so, the funding isn't any different for, the available funds. And you have what I look at is you have 2 benefit schedules, really. You have Plan A, which is one benefit schedule, and Plan B, which is another benefit schedule. So within one plan, you have 2 benefit schemes, one for police and one for civilians. So, I don't I don't know that as far as the consideration of a COLA, and I think this, Vicky would probably be able to speak to this better than me, it would make any difference whether or not you're looking at the police benefit scheme or the civilian benefit scheme.
Thank you, Vicky. Do you have any additional thoughts on that line?
I don't know, in terms of the COLA, I mean, I understand why we keep track of it separately, because the police scheme is at a higher rate than the civilian. You want to track that and you want to identify if you need to fund more in that particular scheme. So we do internally at the county, when we are applying a pension, we apply a different rate or charge to the police, those who are eligible for the police plan versus those who are eligible for the civilian plan. So basically, that even internally identifies that the amount that we're contributing throughout the year is applying a higher rate to those police wages. So we are doing that, and actually, I guess, charging, I mean, it's just a charge scheme in terms of how expensive is the police versus the civilian, right? So I think that's totally appropriate. And in terms of saying, do the civilians, should they be more eligible for a COLA because their pension plan is not as generous perhaps as the police? I'm not sure there's an argument there, because the police and the civilians are both subject to the same inflationary, at the same time. So,
Well, so I appreciate Joyce's letter and trying to think about the two, because I know historically we looked at it and we had actually, I think, the board, and then Milt took it to the committee, had offered a plan to try and increase the funding to the police so that we could get those two numbers back in line. And that didn't go anywhere. It may be time to maybe float that proposal again to see if we can have some success with that. But my recollection, and please correct me if I'm wrong, we had an actuary look at what were the drivers, what were the years that drove that funding gap? And it was the actuarial assumptions were too low relative to actual expectations, i.e. there were more retirements, or there were salary adjustments that went up that reduced, that were going to increase the benefits that reduced the funding level. And I don't think we had that experience on the civilian side. And so the question would be, if the police have been able to enhance their benefits over time, and that's brought the funding level down, and now we're not providing a COLA because of this 80% threshold. When if you look at the civilian plan, civilians are above 80% threshold, and so we've tabled some of the COLA conversations. Maybe we should be having those COLA conversations with respect to the civilians, because they haven't had those same salary increases that led to the funding differential. Does that make sense? I mean, that's I hope I'm doing her letter justice. I think that would be the argument for why you would look at the two separately and maybe consider a COLA for the one and not the other.
Yeah, I feel like the answer directly to the question that was posed, which was a good question, is that we haven't historically separated them out for consideration. It's been a single consideration. I think the question as to whether we should separate it out is also a good question, and one that I don't think we're prepared to address in the short term. I think we need to look deeper into the numbers and get some additional views. At least that's my initial thought. Other comments or questions just in regard to that limited topic?
My only question would be, what's the additional work or analysis that's going to be done, and who's going to report their findings back to us?
Yeah, I guess I would ask Maggie and Vicky, do you have additional thoughts on resources to dig into that a little bit, or some additional thinking on that? I know it's an open-ended question, but
Yes, I would
What specifically is the question?
restate what exactly would be the study that.
For purposes of looking at a COLA, are we supposed to look at the planned funding level in the aggregate? Or are we able to look at the funding differences between the two schemes, I think was the word you used, but that doesn't seem like the.
Well, yeah,
Right?
maybe schedules.
Schedules,
yeah,
right?
Yeah,
Okay,
yeah.
so that's,
Yeah, the ordinance doesn't indicate one way or the other.
Right.
As far as I can tell. All you can look at is the historical actions of the board, which is that they've considered COLAs across the board. They haven't made a distinction between, those who are in the Plan A schedule and those who are in the Plan B schedule. So,
was there a meaningful difference though in the funded level prior to the last, because there hadn't been a real COLA consideration, or at least in my opinion, until recently. What, was there a difference in funding levels going back 10 or 20 years?
Yeah.
It's all.
so my recollection was there was one funding level gap in the early 2000s and another one around Prop P,
Yeah, that's probably about right.
so 16 or so.
So,
something
yeah,
like that.
ballpark, yeah. I mean, 18 is probably kicked in 17,
Okay.
18, so
2018, I believe.
2008 is when it went into effect.
And that's what led to, I mean, it was almost, you know, if on average we're 75, it was, you know, it'd be probably 85 and 65.
Yeah.
Was that gap,
Gap
right?
wide.
Which is what we were trying to do, was to say, okay, to the extent there's a funding gap, we requested the county over 5 years to
It was
put,
40 million, I think is what it
Yeah.
was, something like that.
yeah, to over a 5-year period, look at what that gap is and put that additional funding.
Increased contributions.
I do think some of the changes we made to the plan, where we, instead of having it a rolling 25-year period, we did the fixed 25-year amortization period. I think those things help with it.
It's still 25 years.
But it's still 25 as opposed to getting that, you know, that extra funding. Now, again, that's a question for the county. Do they have the funding to be able to make that happen? And based on our recent requests, I can assume the answer, but it doesn't mean we shouldn't. I mean,
Yeah, I'm gonna suggest that we table this for now. I think it's
Okay.
a good question. I think you're right. We don't have a very specific follow-up question, so maybe myself and we'll have some discussions with, see if we have a better question to ask.
Well, and just to help me understand, because again, I'm a little naive, but so we're talking about two different things. You're talking about obviously the difference in the funding level between Plan A and Plan B, and then you're talking about a COLA. And I guess I just don't understand the correlation.
so
I mean, I do, but I
the
don't.
guideline had always been, and it was a guideline, not a law or rule,
Right.
but the guideline had been, if our funding level was below 80%, it probably wasn't prudent to be making COLA
Right.
increases. And so we followed that guideline for a long time as we moved closer to 80%, we got comfortable, okay, we can do it. Well, 2022, we had a big drawdown. And I think that was the kind of council actually amended our proposal and then almost tabled it or declined it. And then it ultimately went through. But if you have one Plan A, that's above 80%,
But I guess historically, I think that, again, maybe I'm wrong.
Actually, there are two principal guidelines, and I think Paul put them in there.
And-
Originally, it was 80%. We would consider, or the board would consider, whether or not to grant or recommend a COLA if the actuarial funded ratio, not the market value funded ratio, but the actuarial funded ratio was 80%. That was the original approach. In 2021, I shifted that approach a bit because our market value was so outpacing the actuarial value that it appeared to me to be overly conservative to use the actuarial value as a basis for discussion. Now, at the beginning of, or let's say at the end of, let's say December 2021, on a market value basis, our funded ratio was actually 85%, approaching the 90% target, which I've always felt was our responsibility from a fiduciary point of view to strive for, 95% plus. So we were in sight of 95% plus. We were at 85% on a market value basis. But we had a horrible year in 2022, as everyone knows. And the funded ratio on a market value basis went from 85 down to 65. 5 to 65. So now we are substantially below what I would think would be a starting point for a discussion on a COLA based on that particular principle of 80%.
Thank you, Mel. Jerry, I think you're still trying to separate out the
Right, so like,
issue of.
yeah, the last couple of years, we've talked about the funding level, but we've never differentiated the two.
Right.
Maybe in a peripheral conversation, but we've always talked about a funding level as one number.
Right.
Agreed. I think the question at hand is just if
we should be looking at it differently.
Yeah.
Okay.
All right. What if one plan was over, one plan was under? Would we think about it?
Right.
Yeah. Would we?
And I'm just trying to.
And should we? And could we?
Right.
Because the argument would be the civilian plan did not benefit from Prop P. And
Correct.
so that pulled the funding level down below that 80% guideline. If not for Prop P, or if they were two separate plans, they would be above 80% and we would be more comfortable evaluating a COLA, right?
Right. So I think that's the question. I don't think we're in a position to consider that at this point. I think it's a good question and something that we can continue to move forward over, before we do this consideration next year.
Okay.
In regards to the COLA in general, I think I'd like to hear from the trustees as to their thoughts on their interest in entertaining a COLA, given that our funding ratio isn't where we'd like to be based on our guidelines, or whether we'd like to consider the fact that inflation shorter term has been higher than average and that should come into play. So thoughts from any of the trustees before we move this forward?
Yeah, so I'll go first. I mean, obviously, going off of the guidelines that we have set, and again, I'll say they're guidelines because they aren't hard and fast.
Right.
So the two guidelines, obviously, is a fiduciary, then you start to have some concerns because of the funding level is where it is. So we're starting at a funding level like, what does it say, 65?
65 as of
65.
the beginning. It's
However,
about 69% right now.
Right, so it's lower than where to your point, Milt, it's lower than where we would like it to be.
Right.
However, we have experienced historic inflation rates over the short term, and that does impact our retirees. And so I'm not naive to that, or I'm not dismissive of that. So while I tend to lean toward and I talked to some of the retirees on the police side, not the civilian side, but the retirees, and they had obviously a slightly different proposal that wasn't on here, but assuming that these three options were available, then I would probably lean toward trying to at least match inflation. So I know we didn't do like a 3%, which is above that, but I would tend to lean toward that. So I don't want to be dismissive of the guidelines where we're not meeting our guidelines necessarily, but at the same time, I do think we have an obligation to our retirees to try to help with some of the inflation costs that are going on. So that's kind of where I land.
Thank you, Jerry.
Yep.
I think Milt's already expressed his view.
Well, yeah, but please also keep in mind the guidelines are really what must, in my opinion, dictate a decision. Aspirations as well as guidelines. What are we trying to achieve? I think we're trying to achieve 90% plus funded level. I think what we're trying to achieve is not increasing our underfunded ratio by implementing cost of living allowances that we can't finance. So I think we have to be very clear-minded as well as somewhat rigid as to what the guidelines are, because that dictates strategy.
Thank you, Mel. We have Tony or Emily, Jody, Brian, anyone else want to jump in here?
This is Tony. I don't have clear thoughts on this. I think your point about additional data, I think is right and would be helpful. I think kind of getting at if there was a COLA adjustment, what that cost would be, to me, would be a very important piece of data. That said, I generally find myself aligning kind of with Jerry's comments and not at the not discounting at all kind of the guidelines and Milt, your point of view. But also what's in my mind, I'm not an actuary and I don't know how to forecast these things, but with inflation rising, interest rates are also rising, the discount rate is rising. Wouldn't that have an eventual improvement on the funding status of the plan? And if so, is there a way to kind of look through or look forward a little bit as to what that funding status might look like, even in light of a COLA adjustment?
Tony, I think that's ultimately, I mean, this is when we were having the conversation about the discount rate.
Yeah.
And I agree with you. I was having a hard time with, if you look at the rise in interest rates on government bonds.
Right.
In 2022, it was unprecedented, and you had a decline in the level of our assets, both the bonds and equities.
Right.
That the discount rate went up, and so we moved our discount rate up slightly.
Right.
The argument would be that over time, as inflation and fixed income rises, we're a lot closer to being able to get our, what was it, 7.5% discount rate, 7.25% discount rate just on government bonds than we've, treasury bonds than we've ever been. I had a hard time reconciling how our government obligation, our benefit obligation, didn't decline in line, but it's because the moves thus far on the discount rate have been relatively small. Now, maybe we didn't go as low as the market reflected, and we were being conservative at that time. And so now, there's not as much room to move up. That may be the case. We'll have to, I think, evaluate that over the years. Is that discount rate appropriate given inflation assumptions? But I think that's where the discussion of the benefit obligation ultimately is had.
Thank you. You put that in perspective way better than I could, but you're exactly what I was thinking is that this could be a gradual movement of the discount rate. And I'm thinking more of forward looking rather than backward looking. And you articulated that well.
Thank you. And I guess I'll just, Emily, I don't, if you want to jump in, feel free, go ahead. I guess my view.
I'm fine, Brian. Yeah, I'm fine.
Okay. My view on it, well, first, just about the guideline and in the inflation context, as Jerry said, we've had unprecedented levels of short-term inflation. Over the longer term, it's been more benign. But you've heard me a couple of years ago argue that I don't think that benign level was sustainable. I'm not saying that we're going to have 9% inflation every year as far as the eyes can see, but I do think we're going to have a period of inflation volatility. And so to the extent that we're not able to, we've got this guideline and we're not at that 80 or even 90% threshold, I would say it would be inappropriate to provide inflationary adjustments, but I would be comfortable doing something so that we don't find ourselves in a situation where we've got to play wild catch up. And so that's my view. I would like to get to the point where we could do a COLA, 1 or 3% based on inflation, or 2 or whatever the appropriate number is. But knowing our experience last year with the county council and them, trimming off what we had already done for the other people who'd already received a COLA. I was just trying to say, okay, well, what if we move the people who only got 5% last year to 10%? And what if we move the people that didn't get the last tranche that didn't get anything last year to that 5% threshold? And then what if we gave 2% to people who've been retired 2 or more? It doesn't touch as many people. It doesn't have as much of an impact on the funding level or the amount of the county's contribution, but it's making progress towards getting everybody something, so that hopefully we're in a situation with either the discount rate going up, hopefully it's assets going up in conjunction with that we're able to do, more sustainable covering everybody. So it was good for me to see the 1% and 3%. And if somebody wanted to offer it, I'd consider it. But I was really hoping that we'd be able to do something. So
So you're at number 3.
continue. That's why I just asked. I just wanted to see what the numbers would look.
Let me pose this question then, just taking not even a devil's advocate point of view. I think it's a reasonable point of view. At what level of inflation would we not do something?
Well, we had a period where inflation ran below 2% for a long time, and we didn't do anything in those periods.
I think that's the history for most
Right.
of the last 20 years.
Right.
We haven't done anything in a period of low inflation.
That's right. And that was not and the plan, although the plan verbiage in the plan are that we are to look at this each and every year, but there was no action taken in the past. I'm simply asking now, if we want to consider a COLA in view of inflation, what level of inflation would we not consider a COLA? Because we've got to be very clear and definitive on our objectives and on our guidelines, or every year there's going to be another debate as to whether or not we grant a COLA. And that's not how this plan was set up.
I think we should have that debate on an annual basis,
yeah.
Milt. I guess I take the view.
No, I'm saying, yeah, but, well, you should have the debate if it's within your guidelines.
Mm-hmm.
If
we were back at 70%.
1%.
Excuse me.
Has a problem with the 1%.
Brian, excuse me 1 second. If we were back at 70% or 65%, because that's where the market value was, 65% market value funded ratio, 65% actuarial value funded ratio, just an example. Would we even consider a COLA? Would we recommend a COLA? I don't think we would. I don't think we would have reached that trigger point, a reasonable trigger point, that would allow us to consider it reasonably. So again, I'm going back to what should a guidelines be, and the guidelines therefore should dictate whether or not we should recommend a COLA.
Mm-hmm.
Otherwise, we have no guidelines.
I would agree with Milt. This is Jody. My heart goes out to folks who've experienced high inflation, and I would very much like to do a COLA and give them funds, but not at the expense of our fiduciary responsibility to the fund itself. The guidelines are there for a reason. They weren't in there to say whether we should use them or we shouldn't use them. They're there because we have a responsibility to the folks who have already received a COLA, the folks that need a COLA, and the folks who haven't retired yet. We need to keep the fund intact at a reasonable level. And I feel very strongly we need to follow those guidelines. And I think it's important we do look at this every year and have a discussion and talk about the inflation. I think they're all very valid points and we need to talk about it. But at the end of the day, if the fund is not sufficiently funded to move forward with a COLA, that's our responsibility, even though our hearts are in a different place. It's our responsibility to draw the line. And I don't think a COLA should be done at this time.
Thank you, Jody. It's an interesting debate. I mean, I think we've got guidelines that do not include an inflation metric in the guidelines. So inherently, we're starting with the idea that we're only going to pay attention to the funding ratio. But the reality is our ordinance says we need to pay attention to inflation as well. That's supposed to be part of the consideration. The inflation numbers are high, short term. The funding ratio is below our guidelines, but probably adjusted to more recently on a market basis, not so much. We have had a history of going outside of these guidelines very recently, at least to consider other factors. So I think, I share the view that while the guidelines don't suggest that we should do an increase this year, I could be supportive of a small increase. A secondary question that these scenarios get at is, do we do across the board, or do we do, if we were to do something, do we do across the board, or do we continue this historical pattern of trying to adjust? I'm a fan going forward of getting towards across the board and not doing this kind of, scattered adjustments. I think that complicates the conversation. I think there's validity to it. I think specifically when we were looking back where we were 2 years ago, I think as we move forward, at some point we need to move to an across the board. So I would be supportive of either a small across the board or saying, look, we're not hitting our guidelines this year. Let's not do it this year. And let's maybe reconsider our guidelines as we look forward to next year to think more about inflation. Any other views?
I think, again, the guidelines are our guidelines, so they aren't set up by ordinance. They're the guidelines that the board set. So, we have two of them, which is the funded ratio. The second one is projected funded ratio doesn't decrease by more than 2 percentage points. I'm okay with adding a third one, which is you take into consideration inflation, and then we balance the three of those as our guidelines. Now, as far as this year's goes, I would probably recommend that you do two things. So we'll vote on whether we want to do a COLA, but I would also probably put forth something to the council to adjust the funded level. So that way, because again, the discussion always goes back to funded level. Where are we? So if we're talking about trying to get our funded level up, at the same time we're saying we can't do a COLA, so can we not put both of those forth? Which is we asked the council to, again, take into consideration. We asked a couple of years ago, they didn't do it, but you asked them to take into consideration some, and I know it's not time to ask the council for money. Yes, I'm well aware. But I think it's, again, you want to talk about our fiduciary responsibility. If that's, Jody, if that's your concern, no, if that's your concern, then why are we not making that concern known? At the end of the day, it's not our decision to make, it's somebody else's decision whether they choose to do it or not. But at least our decision, or at least our opinion and our thought process is put forth, and then they can choose to do what they want with it. At the end of the day, they're going to choose to decide whether they want to do a COLA or not at the same time. So, we can all say, hey, we want to give everybody a 15% COLA. Tell us that they're not going to do it, right?
Agreed. And I think as we look at our, we have that.
Correct.
The county's issues and considerations, county councils are a different set of
Consideration.
Right. And so I don't think we need to worry, in my opinion, what they're going to do. We put forward the proposal that we think makes sense based on our guidelines and our responsibilities, and then they can make their own decision at that level as to whether they want to take that into act on consideration. Right.
The question is, our overall objective still, or should it be, that we're trying to achieve 90% funded level on a market value basis in a reasonable time period, not the next 10 years, but in a reasonable time period? With certainly 10 years is too long, as I didn't say that right. 10 years is far too long. Reasonable time period would be within the next 5. Is that a reasonable target? Is that a reasonable objective? Is it a reasonable guideline? That's what's not a guideline, but it would be an objective. Is that a reasonable objective? And is a COLA consistent with that?
The one thing I think we have to be cognizant, though, of is that we set a guideline in a period where we hadn't had inflation. And so we are required to consider inflation, yet inflation's not a factor in our guidelines. And so if the objective is to get to 90%, which I think is a good one, and there is some level of funded level that you wouldn't make any COLA recommendation under any circumstances, that the guideline is probably tiered. Above a 90% funded level, you're probably we're probably all comfortable recommending almost a CPI type increase. If you're between 90 and whatever that minimum level is, it's some discount to historic inflation. and what that discount is, or how you structure it to try and take care of the people who haven't been received. I mean, I think that's what we did that first time, is that the notion was, okay, we're worried about inflation, that even, and now it's 2.6% for the 10-year number. It was below 2, I think, when we did 10% for everybody who'd been retired more than 10 years, under the notion that even nominal, or, benign inflation has an impact when it compounds over a 10-year period. And so I would, look, I'd be supportive of some, obviously some discount to inflation. I was trying to, when I suggested the 5%, and 2%, I just wanted to see if we could continue to make some progress. I understand that this is a year where we're not likely to have success broadly. I saw what happened last year. I don't know that enough has changed. I want to make a recommendation, if we make a recommendation that we think has a reasonable likelihood of benefiting people, as opposed to just throwing some number out there that I mean, maybe that's the right thing to do. Maybe it's throw the number out and let somebody else turn it down. But I mean, that's not where I'm coming from.
So I think what I'm hearing from the group broadly is that as we move forward, we're certainly not going to change the guidelines that we considered for this vote today before we have that vote. So as we look forward, we can consider making inflation part of our guidelines. We can relook at Milt's question as to the 90%. I think that's something maybe that we look for next year, is should inflation be built into our COLA consideration guidelines, or shouldn't it? So I think from a standpoint of, I hear a couple people mentioning that, so we'll do that going forward. From a standpoint of the vote today, I'm hearing a group here probably supportive of saying the guidelines are what they are, and they don't support an increase. And I hear a couple of people saying that they would support, and I'm now putting words into people's mouths, but maybe an across the board lower increase. So maybe something closer to, Brian, I wasn't quite clear if you were saying you would support a 1% or a 3%. Were you saying I'd only support 3 because it's not worthwhile to do 1, or were you saying I'd support?
No. I would support 1. I would support a hybrid of 1 and 3. My opinion is we tried to do something like that last year, and they stripped out the impact that everybody had already gotten one. So that's where I think 3 has a reasonable chance of passing. And we're doing something to get us closer to the point where maybe next year we'll be in a situation where we can do 1 or 3, or we'll see what inflation looks like then. We'll see what our funded status looks like then. But I'd rather do something than nothing.
Okay.
So do you want a motion?
I mean, yes, if you'd like to make a motion, or Jerry, do you have a strong view? Milt's strong view has been nothing, so there's going to be no, I haven't heard any other, and then you two have kind of expressed strong views. So Jerry, would you propose something different?
Well, we could play this game all day long. What about, 3% for this year and 2% for this year? I'll be honest, I do kind of like Ryan's, which, again, so if you look at what we've done, the first COLA in 2022, everybody from 2010 and earlier got a 10%. 23, we did, we kind of did that. Everybody in 2011 got 10%. Between 12 and 16 got 5%. Brian's proposal of 5% for 2000, again, so the scenario 3, 5% for 2012, 5% for 2017, and 2% for everybody from 18 to 20. And that gives, basically, we get everybody up from 2012 and below has now had a 10% COLA over at some point over the last 3 years. We're still missing, well,
everybody who's been out 5 years has gotten a 5%
actually,
increase.
yeah.
Everybody who's been out 2 years has gotten at least a 2%.
Yeah, and so I support that. So I'll make a motion that we recommend the COLA for scenario 3. I think that's reasonable. I do agree with Jim, which is as we go forward, we should probably stop the shotgun approach. But I do have a lot of empathy for those people that have been retired for a long time. Their salaries were significantly lower if they retired in 2008 or 2007. Their salaries were significantly different, and they're impacted significantly, so. I- But my point
No,
is,
I appreciate that. And just going back to my previous comment, as to the guidelines going forward, I think before we do this vote next year,
I'll make a
we need to
proposal.
firm up the guidelines so that we can be more, because I would like to be more guideline driven as well.
Yeah.
I don't think the guidelines right now are bringing into play the inflation side of the equation. And that's where I'm
We can
having a
add that
challenge
guideline,
as well. So Jerry, you wanted to make
is that
are you going to make, are you going to make a motion on,
I second it.
on scenario 3?
Jerry, can you repeat the motion? I'm sorry.
yeah, so basically the motion is to accept scenario 3
Recommend.
for
Okay.
recommend scenario 3 for COLA
Okay, thank you.
council. Yeah.
Okay, so we have that. Do we have a
I'll second.
second? Brian is seconding. All in favor?
I,
I,
Okay, opposed?
Opposed?
Okay. Okay.
do you need a roll call since who
You do.
opposed it? I don't think we,
Jody,
Jody will oppose.
You can ask for roll
Okay.
call.
okay. I mean, I didn't know if you could see or hear.
No, we got it, Emily.
So
Okay,
was it 5-2?
we had a 5-2, Milt.
Okay, all right.
And I will, I'll solicit some views from the trustees and endeavor to relook at our guidelines as we move forward so we can try to, as suggested, I think we agreed to, we'd like to be more guideline driven, moving forward to reduce the gray area, so to speak, in our consideration. We can.
Since the vote is taken and everything's resolved, I would just like to offer just one other thing as an observation. This is not a pension plan which was based on the principle of annual cost of living adjustments. It wasn't set up that way. Plans which are set up that way are very explicit about it. This was never anticipated. I would suggest we be very cautious about creating an expectation at the county level and at the retiree level that we are in the future, we've already made our decision here, but in the future that we're essentially moving in the direction of a cost of living, annual cost of living allowances. And when you do that without the context of what your funded level is, you wind up compounding your liabilities.
Yeah,
And
I
it
think,
becomes self-defeating.
no, I think there's agreement that the funding ratio is obviously a paramount importance in our consideration, but inflation is also in our consideration. I think to the degree we move forward here and relook at the guidelines, this will be a robust debate around, how we balance those two things. And so I agree.
Right.
Yeah. Okay. Thanks everyone for that good conversation, and we'll move on to agenda item 9, which is the drop program. Jerry, do you want to give us your 30-second?
So yeah, just a quick update. We've had a meeting scheduled for next week. So I would look forward to bringing something back to the board in a month, next month's meeting.
That's great. I'm gonna just leave this as an item here so that it's clear that it's something that the board will hear about. If there's no update, there's no update. If there's an update, then we'll have an update, and then we'll get this resolved. And thank you for participating. Any other comments on drop while we move on? Okay. Thank you. We're on to other business. Thank you, Jerry. Sorry. Any other business that needs to be considered at this time? Okay, I think we're on to visitor comments then. So let's open the floor to visitor comments.
Joyce, Dave, do you want to be?
Yes.
Pass it down. You're receiving a handout I'm going to refer to, so. First of all, good morning, board members, county staff, and their attendees. I'm Dave Gopin of St. Louis County retiree. Probably most of you know that. I draw the board's attention to the first paragraph of the handout you just received. It highlights 4 funds in St. Louis County retirement portfolio that lag far behind their appropriate benchmark for the entirety of the decade, 2013 through 2022. These combined losses amounted to over $3 million compared to the benchmarks. To the credit of the board and ACG, they are replacing one of these funds, Sanderson. Ironically, Sanderson was the least losing of the 4 funds. Not only that, but the replacement fund was another active management fund instead of an index benchmark fund, which just soundly beat Sanderson. The dogmatic blind allegiance to active management by the board and ACG is not in the best interest of either the St. Louis County taxpayers or its retirees. The general superiority of passive management compared to active management is not just my opinion, but rather is borne out by much professional research, such as the S&P indexes versus active management, or SPIVA, which shows over the long term it is extremely hard to beat the market. I've sent this research to the board before. It basically shows fewer than 1 in 5 active management funds beat their benchmarks over time. In addition, passive management derives from multiple Nobel laureates' work from the University of Chicago. Not to cast aspersions on the board members' investment, but can you just ignore the work of Nobel Prize? I will leave this question with the board members and especially with the investment profession, because active management has a 1 in 5 chance of long-term success against its appropriate benchmark. If you recommend an active fund, is that investing or gambling? I hope you seriously consider this because you are our fiduciaries. Thank you.
Thank you. Other comments?
Yeah, I guess I'll speak.
Thank you.
Hello, everybody. Good morning. Joyce School, retired from St. Louis County Juvenile Court. I just want to say I'm very thankful that you had this discussion. I've been coming for several years, and I do appreciate that you are going to take a look at some of this. And I guess the thing that I was confused is when I came here, because I had worked at the City Juvenile Court and I had worked with the Division of Youth Services, and they all have a drop and they all have a yearly review. Not that they get a COLA, but they have a yearly review. And I can't find anything anywhere. And I've only been retired since 2018, but for the last 10 years I've worked, we didn't get any kind of a raise. So I'm going on about 15 or 16 years. But I just am confused as to why there was no record of anything or a COLA even considered that I could see between 2005 and 2022. And that's a very long time. And I see what has to happen now. People are trying to catch up for what wasn't done, for what reason, I don't know, because I wasn't here. And we just don't seem to be consistent with the other public pensions in Missouri. And I don't know whether that's good, bad, or indifferent. But I did do a lot of research on the different Lauders, Mosers, the city, Jackson County, all of those. And I don't know, I know I sent it to the county council, but I don't know if anybody would be interested in looking at that. I'd be glad to dig it up. But most of the time, what I've seen is you have to consider the funding ratio and you have to consider the rate of inflation. Now, the problem is we haven't really looked at that nor done it that way. So I see the point where you're trying to bring everybody up to equal status. And that's kind of what I was trying to say, that we need to come to some place that's kind of here and then move forward looking at what is the rate of inflation and what is our funding pattern. And that's why I had the questions as to what was used as a basis. But I really am very thankful for that discussion that's been started, and I hope we keep it up. Thank you.
Great. Thank you, Chris. Any other visitor comments? Okay, thank you both for those comments. All right, I think we've reached the point of, we've got the next meeting here on the agenda, and we've reached the point of closing the meeting. So I'll hand it back for
Do you need a motion?
we need a motion, sorry.
Motion to adjourn.
Motion to adjourn. We have a second on the motion to adjourn?
our online friends.
Yeah,
We
Jerry.
need an
Tyler, we
online
need somebody
motion.
on.
Tony, would you give us a second to close?
Second to close. I second the motion.
All in favor?
Aye.
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 Okay, all votes. All right, thank you very much.
Everybody in with that.
Yeah.
Thank you.
Thank you all online, appreciate it.